One area that we notice a lot of retirement plans failing to address properly is in the area of expenses. People spend a lot of time thinking about what kinds of expenses they're going to have, how much income they're going to need, what investments will give that to them. But over the years of helping federal employees with their retirements, we've noticed there's 4 major categories of expenses that often get overlooked. So I'm going to talk about what these are so that you and your advisor can incorporate this in your own retirement plan and maybe give yourself a better chance of having a successful retirement. Here we go. The first expense that's often overlooked in retirement plans are one-time expenses. We've been helping feds with their retirements for a long time, and boy, it's amazing how many one-time expenses there are in retirement. Maybe our friends tell us they want to do an excursion to Iceland or Italy, and they want us to come with them on these sporadic trips. That sounds amazing, and you want to go, and so we encourage you to build this kind of flexibility in your plan. Another one, many of you have kids, right? And even though your kids might be adults and they may be technically off your payroll, they're never fully off. And maybe it's not your kids, maybe it's your grandchildren or nephews and nieces that you want to be able to help support. As parents, we want to be able to help our kids and do as much as we can, and this is definitely doable, but I do caution retirees to remember that their financial independence should come first. If you become a burden later in life because you weren't smart about your money along the way, then that's not really helpful to anyone. The other way one-time expenses creep up is often with cars. How often do you find yourself having to buy new cars? Do you keep your cars for 10, 15 years? Or are you trading them out faster than that? This is a big one that we rarely see inside retirement plans, and this is especially important if you pay in cash. Another way is that many of us also still have aging parents that we might be helping look after. So sometimes if their health has gotten worse, you might find yourself doing more trips to visit them more frequently, or possibly even supporting them in some kind of financial matter. And please hear my heart on this. I'm not saying you shouldn't be supporting your family. Absolutely. Your family is one of the most important things in life. But the point is that you do need to consider if this is something that could be possibly in your future, because this kind of surprise expense in retirement is one that can be more challenging to deal with. Another one that we often see come up, especially as kids get a little older, weddings, right? Sometimes we also see higher education. Sometimes there's a couple of new grandchildren that maybe you weren't expecting, and you also want to be able to help support their education too. We love that. We always want our clients to be able to support their family and help the kids get through education. But we encourage that people be thinking ahead of time, because it's better for you to save for it and not need it than end up not planning for it and requiring it. So you can see there's a lot of one-time expenses that just seem to creep up in retirement. Things that you want to make sure you leave in enough buffer room, especially in the first 10 years of your retirement, which we call your go-go years. The likelihood of your doing some more spending, more traveling, being more spontaneous tends to increase in early retirement, especially compared to later down the line. All right, this next one is really important. In fact, a lot of research talks about how families will need $300,000 in retirement for this expense. And unfortunately, up to 70% of people over 65 will encounter this expense, and that's long-term care. The Department of Health and Human Services talks about how 70% of people over 65 and up will have some type of long-term care event in their retirement. And we've looked at a lot of retirement plans that people have brought to us over the years, and this is one of the areas that are very often missed, or at least not accounted for in the most appropriate way. What happens if you have a $300,000 need later in your life to care for your health? If you don't start planning for this before you're retired, or at least in the early stages of retire, this is something that could really become a challenge. One of the things our clients tell us is really helpful to them is being able to look at what-if scenarios. And so what if you have a long-term care event that costs you $5,000 a month for a number of years early in retirement, in the middle of retirement, or late retirement? What if it's more than $5,000? That $5,000 for long-term care is more in line with in-home care. But if you require a facility that has some additional support, it's not unusual to experience $10,000 a month in expenses. And the biggest surprise that people have about this is that your health insurance, to include FEHB plans, does not cover long-term care. Health insurance will take you up to a point, at which point the insurance is going to drop off and the rest of the care is going to be up to you. Now, of course, this is where long-term care insurance can be factored in, but even like I said before, there are some exclusions, and unfortunately, most Americans don't have long-term care insurance in place. So you want to be talking to your advisor and checking if you're going to be self-insuring for this risk. Can you afford to do so? What are the risks affiliated? Or if you're going to be passing on the risk to an insurance company, by getting a long-term care policy. So a lot to think about. And if you're planning your retirement, or maybe you're already retired, consider subscribing to the channel for more videos just like this to help make your retirement better. The next expense that's often overlooked in retirement is how Medicare can start to creep up on you. And there's a few ways that can happen. Now, before you say, Thiago, I'm on FEHB, I don't need Medicare. True, sticking only with FEHB plans can be done, but for most families who can afford to also get Part B, it is highly encouraged. There's a reason that certain FEHB plans incentivize you in the form of reimbursements and all kinds of other benefits if you go to Medicare Part B. Plus, if you're on TRICARE as former military, then you are forced to go to Medicare Part B as soon as you hit 65. So consider incorporating that into your plan. Now, when we talk about Medicare, there's really two categories that we need to discuss. The first is Medicare Part A, which is basically for your hospitalizations. A lot of people don't realize that there is a $1,600 deductible on Part A, and this is per benefit period, which sounds like it's per year, right? Well, it's actually not. It's per incident that puts you in the hospital. Medicare defines a benefit period beginning on the day that you are admitted to a hospital. Now, the other section that this is impacted is your Medicare Part B, which is really considered your standard normal health insurance. Now, a lot of feds don't realize that the amount of your premium is based off of your taxable income. So as your taxable income goes up, so does your Medicare premiums. So how does this one creep in? Well, remember that your FERS pension is fully taxable. So you're already starting at a certain base. And then every dollar that you take out of your pre-tax retirement accounts starts to increase your retirement taxes. So as you're living retirement and you're spending money, you're also increasing your tax bracket along the way. And again, $1 over puts you in that higher Medicare bracket. Each one of these brackets increases your Medicare by $100 per month. And so again, if there's two of you, you're looking at a $200 increase per month. So a $2,400 a year increase to your Medicare premium for a couple of years, just because you weren't careful with your distributions. And if you haven't seen our videos on how your retirement income system should work in retirement and how to avoid some of these issues, our team will put a link in the show notes below the video for you. All right, the next overlooked expense in retirement is the cost of maintaining your home over time. As you age and live through your home, you might find that your home maintenance costs begin to creep up as well. But have you thought about the cost of needing to replace your entire roof? What about the plumbing and electrical systems? Do you need to have a new electrical box inserted? How is the foundation of your house over time going to hold up? These are expenses that can sometimes creep up and all accumulate on the same year. So you might be looking at something like $30,000 or $40,000 in extra expenses on your home, on top of whatever you needed to be able to live your life. And there's something else that you should be considering, and those are the things that you should stop doing in order to have a better retirement. And this video on the screen talks all about that, so make sure you check that out. And until next time, stay wise and stay wealthy.